Welcome to Discovery Watch with John Kaiser.
I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, pleasure to be back on the show.
John, Yorbo Resources is awfully quiet. Did they miss the Lemoyne target?
Well, when we looked at the market on Monday morning, it was pretty quiet, and everybody had that sagging feeling, they were supposed to hit target 1 on the weekend, but they apparently did not, which means the Lemoyne 2 play was a bust. But we subsequently found out that earlier in the prior week, the wedge hole that they had started at an 800-meter depth, they realized that it just wasn't steering properly enough to hit the target. So they decided to abandon the 800-meter deep wedge, which would have been a quick run to the target, and stepped back to the 400-meter level, fiddled around for a while to make sure the wedge was properly started, and got that underway last week. But because they're starting from a much shallower depth from the pilot hole, they were not going to hit the target last weekend as they would have if the 800-meter wedge had been on target. So now they are saying, based on the progress that we had as of Tuesday, where we were at 750 meters, we should hit target 2 at the 1,200-meter depth sometime this weekend. So again, we're going to have to sit on tenterhooks this weekend to see if they get to the target, and number 2, that the EM conductor is massive sulfides that include the base metals, zinc, copper, lead, and instead of just massive pyrite and iron sulfide, which is absolutely worthless. Now, everybody's pretty optimistic that there will be the other metals for traditional VMS deposit present, because there are holes in the periphery of this target that nip the narrow intervals of traditional VMS mineralization. What we will not know is whether or not this has the same gold enrichment as the 760,000 ton original Lemoyne deposit, which pretty much starts at surface and then was mined out down dip. This target is somewhat deeper. There have been deeper holes drilled down to 1,500 meter depth, but they were away from this area where the downhole geophysical pros showed that here is a conductor, a very strong conductor, for which either graphite or massive sulfides are the only explanation, and the context is not one where graphite is going to be the explanation. The bad case scenario is that it is just simply unmineralized iron sulfides. And the key is the gold. The Lemoyne is the second richest VMS deposit after SK Creek in the Golden Triangle of British Columbia. And right now, with the COVID surge in its second wave, worse than the earlier wave this year, now we are waiting for 8 to 12 weeks turnaround time for assays. It's become a terrible situation. So if we do hit, we'll get visuals on the copper and zinc and lead if they are present, and then we have to sit back and wait for the assays to see whether this is indeed a gold-enriched VMS deposit. But I think the context is such that if they do hit, this will create a little bit of a Christmas area or discovery type play, because it is close enough to the existing Lemoyne deposit that's now mined out to, if they hit something that looks similar within the same Wakanichi formation stratigraphy, this company has 370 million shares out. It's at 5 cents. About 75 million shares are owned by the insiders. In fact, in late October, before they started the drill program, they did a private placement, $1.5 million at 6.5 cents flow through, no warrants. A third of that was taken down by insiders. And next week, they get another $500,000 payment from IM Gold as part of their Rouen earn-in farm out deal. And so they'll have a couple $1 million to play with. They are very happy with the original hole to be used as a pilot hole for additional daughter holes, the wedges. If they do have a discovery, they are in a position to drill other wedges and keep going right through Christmas. Maybe not even take a break in case the authorities don't allow you to move back to the drill rig. Christmas has been canceled anywhere, just about all of North America. And this stock, because of its liquidity and cheap, and because this is a high impact play, 3/4 million tons makes this about a fourth or fifth the size of SK Creek, which is about 2.5 million tons. It was, of course, richer because it had a substantial silver component to it. But this would cause a lot of old-fashioned discovery play excitement. A couple of weeks ago when we talked about Yorbo, I mentioned another company which owns ground to the south. I only alluded to it. I didn't name it. That company is Andre Tessier's Delta Resources. Their project is called Delta 2, which covers two types of targets. They just finished a 15-hole program testing a number of magmatic hydrothermal gold targets, similar to the Chevron Gold Joe Man deposits farther to the west. And now they are starting up with phase 2 on a cluster of VMS targets. They are about 15 kilometers southwest of the Lemoyne deposit, so it's not exactly a proximity play the way that testing target 1 is for Yorbo itself. But the idea here is that the Wakanichi Formation has formed a syncline between the Shabugamu Pluton to the north and the Bolvert Pluton to the south, and the Lemoyne system is in the northern limb of the syncline, and now they know that there is a southern limb to the syncline with the Wakanichi Formation not previously recognized as present because there's a lot of overburden in that area, so therefore never drilled for any conductors. Delta has developed a number of EM conductors down as deep as 350 meters, so this will be shallow grassroots testing of targets that had never been sought out and tested before. Yes, it's 15 kilometers away, but it is within the stratigraphy, which was the period during which these VMS smoker systems evolved. So we have two potential shots to turn this area into an interesting discovery play. Yorbo itself with target 1, and even if target 1 turns out to be a dud, they have target 2, which is a little bit farther to the north on the other side of the Gabbro Dike. They say, well, we've got the money. We're going to go drill into this. In the middle of next year, we get another $750,000 from IM Gold. So this is a wonderful setup for a potentially explosive discovery play. Monday will be a day to pay attention to see if there is activity in Yorbo. And once you see an announcement that we have hit polymetallic VMS mineralization, I think this play will be a lot of fun because Yorbo's future does not really hinge on the Lemoyne play. This is almost an afterthought play. The market has not built any anticipation premium into it. The stock is easily worth 5 cents based on all the other assets that it has. And they have the potential to go to work on the Beschefer project in Ontario, or not in Ontario, in Western Quebec later next year when they finally wrap up the 100% ownership of that project.
We'll have more with John Kaiser right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with John Kaiser. John, is there any news from SK Mining Corp about its hunt for the SK Creek 2?
Well, Jim, we are still waiting for assays from the 20-hole program, about 4,300 meters, that they completed in mid-October on the TV Jeff area. And this is about 10, 15 kilometers south of the Lulu zone, where SSR spent $8 million a few years ago trying to find the SK Creek 2 deposit that would have been associated with the fluid flow that created the original Lulu high-grade gold-silver mudstone intersection. But as part of this year's complete rethink of the entire project, they did a lot of work all over the project, and they decided to go back to the old TV and Jeff zones that had been intersected more than a decade ago. In fact, during the early Corey project effort to find another SK Creek 2 in the area, and they hit some mineralization, but they couldn't make heads nor tails of it. This drill program that they've done now with the 20 holes has created an awful lot of geological context. It does not appear that they have a huge intersection that's visibly mineralized over a very long length, so that you know that when the results come out, you have an off-the-scale discovery. But they do have many intervals of very interesting mineralization that when they finally get their assays, they will be numbers that the market pays attention to. And this time around, with John DeDecker in charge, they are taking a very holistic approach to the whole play. And this has enabled them to announce a $10 million financing. This was in late November. A week later, it got upsized to $11.5 million, and there is a 20% green shoe, which allows them to buy additional shares, place additional shares when this one closes within 48 hours of it. And so, if the demand is there, this could end up raising $13 million. It depends on whether the combination is the unit, the common unit at 90 cents, the straight flow-through share at $1.05, or the flow-through unit at $1.25. And this company will be in great shape to resume work next June, July, when you can get onto the property. What it will do in the meantime, that isn't entirely clear, but there will be an awful lot of data that John DeDecker can work with. Plus, they've updated the presentation to include additional graphics that allow us to better understand both what's happening in the TV Jeff area as they now see it, and also in the Lulu area. They finally inverted the graphics that they had, which had you looking south rather than north towards SK Creek, and it is now much clearer when you look at it to see what's going on. Next time Quentin Henney does a presentation of it, he won't trip over trying to explain that very interesting graphic, which suggests that the entire Coulter Creek thrust fault was completely misunderstood, and that all the drilling was aiming at an area where it was not possible for the contact mudstone that hosts the SK Creek deposit itself. That's the event stratigraphy where the smoker systems were active and spewed their piles of mineral-soaked fluids onto the seabed floor. That's going to be an additional target that they can tackle next year. So this stock, even though it should be selling off now as we go into the off-season slump for plays in the Golden Triangle, it's managed to go back above $1 in the past few days, and it's a sign, I think, that people are getting ready for what's going to be a very strong discovery exploration year in 2021.
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with John Kaiser. John, in February, you talked about Namibia Critical Metals and its Loftall Heavy Rare Earth Project with JOGMEC mentioned. Rare earths are starting to get market attention. Did JOGMEC accomplish anything at Loftall?
Jim, I haven't talked about Namibia Critical Minerals much since then because the company hasn't had too much to report. The market at the time was a little bummed out because NMI had done a deal whereby JOGMEC, which is a sort of a government entity for Japan, had done a deal where they could earn up to 74% of the Loftall project by funding everything through production. And the market said, well, you've diluted down, you're going to have 26% left of this. It's not exactly a huge project, and the market kind of lost interest. And rare earth prices, they were pretty lame through most of the year. But in the last month, rare earth prices have started to take off. In particular, the ones related to the magnet industry, and that's being driven by the electric vehicle build-out sensation. They are now seeing that the electric vehicle fleet is growing much more rapidly than anticipated several years ago. It seems that despite all the anti-climate change skepticism during the Trump administration and the efforts to pump up emissions and promote the fossil fuel industry, the rest of the world has marched on and said climate change is a real issue. CO2 emissions and other greenhouse gases are contributing to it. We have to do something about this. We have to secure the longer-term future. It's a longer-term future that isn't of much concern to us boomers, who will, the last of which will have become a retiree in 2030, because we probably won't live long enough to experience the full consequences of the planet's temperature continuing to rise as a result of these CO2 emissions. And so the demand for these magnets, which are a key part of electrical vehicles, it has started to go up. And even in China, which is the primary supplier of these rare earths, they can't hold the price down. The price has been cheap since Rare Earth Mania 1.0 crashed in 2011, 2012. In the case of the heavy rare earths, which come from a different style of deposit than the light rare earths, which come from these considerably larger carbonatite systems, such as Bionoble, which is the world's biggest monster at 4 to 6%, which is the foundation of China's light rare earth supply. The Loftall project of Namibia Critical Metals, in which JOGMEC is interested, it is a heavy rare earth deposit. 75% of the rare earths are in this heavy category. Most carbonatites, which are light rare earth deposits, have less than 2% of heavy rare earths in them. There are a few exceptions which get maybe into 5 to 10% of a heavy rare earth component, but in most cases, such as the CLD deposit at the Mount Weld project of Lynas or the Mountain Pass project of MP Materials, the heavy rare earths are negligible. And in the case of Mountain Pass, the europium, which used to be the financial engine for that project, it created the red phosphors and cathode ray tubes. Well, that europium has collapsed because nobody uses cathode ray tubes for televisions anymore. So in the last 4 weeks, the price of neodymium and praseodymium, the key light rare earths that are used in the magnet sector, they have doubled in price. And dysprosium and terbium has doubled, dysprosium is up 50%. These are the heavy rare earths which are used to dope the neodymium magnets so that they do not lose their magnetism under high operating temperatures. So we're seeing a sign that demand from China, which is building out its electric vehicle fleet, is starting to outstrip the supply from the existing operations. And in the case of the heavy rare earths, there's a bigger long-term problem looming for China and the rest of the world, which is that these ion adsorption clay deposits in southeast China, they are a superficial weathering product like a skin on the earth. And these have been very wastefully mined over the past 2-3 decades. Small-scale operations, many of them part of criminal networks, and these are being depleted faster than anybody really wants to hear about. And this is why JOGMEC, which actually has heavy rare earth separation capacity within Japan, did this deal with the Loftal project, which it's fairly low grade, 0.3 to 0.4% total rare earth, so which 75% are the heavies. At the prices that we saw in February, well, the operating cost was about $95 a ton, and the 100% in situ value was only $147 a ton, or $113 a ton. Right now, that's gone up to $147 a ton, which is still pretty low compared to what the prices were in comparison to 2014 when they completed their PEA. The killer with all these heavy rare earth deposits is yttrium, which is typically 50% of the minerals that have the heavy rare earths in them. And the price of yttrium has suffered a similar fate to europium. Its use in lighting has been displaced by LED technology. So the yttrium that's coming out of all these, heavy rare earth enriched ionic clay deposits, it has had a very cheap price. But curiously, although being as below $2 a kilo at one point, it has risen above $3. And in the case of the other light rare earths, ones like cerium and lanthanum, which make up the bulk of a light rare earth deposit, they have not risen at all because there is no new technology demand for these particular rare earths. And there isn't any that I know of for yttrium at this point. So it is interesting to see yttrium start to rise, which means that this depletion problem that has been warned about for some time is starting to hit these ion adsorption clay deposits. And what JOGMEC was doing is with this plan to earn up to 74%, they were securing the future of its heavy rare earth supply so that whether China manages to deplete its resources or even get into a geopolitical spat that suddenly restricts the exports of heavy rare earths, JOGMEC will get these heavy rare earths. Now, what they did this year was spend about $4 million primarily on drilling. And that's not really what the Loftal Area 4 deposit needs. What it needs is more intensive metallurgical studies, and the key area that they can work on is the first stage where they create a concentrate that removes as much waste material before you hit it with acid and energy to dissolve the remnants. And they spent about $250,000 this year doing a comparison between an XRF and XRT sorting technology, and it's still up in the air which one is best. But they need to spend a lot more money on the flow sheet segment. But for the $4 million, JOGMEC was able to double the down dip extent of Area 4, so the existing resource will end up being double what it was and used for in the what it was when it was used for the PEA, and also a satellite showing, which the company had only trenched down in 2011, Area 2B. They have done some drilling there, which has also indicated that, okay, this zone also has running room. There are still assays outstanding for this program, but so far we haven't seen anything to, get super excited that grades are going to be better than what is already known about this system. But there are two reasons to be excited about NMI going forward, even though they only net 26% at the end of the day. The first is this rare earth mania 2.0 is starting to cook. MP Materials completed its merger with the Fortress SPAC about a few weeks ago, and it is already sporting a $3.8 billion valuation. Its only asset is the Mountain Pass project, where they have to still spend another year and $300 to $500 million fixing up both the cracking stage of the flow sheet and the separation facility so that they can strip out the neodymium and the praseodymium. They do not have any meaningful heavy rare earths in that system to speak of, so that's still going to be a problem for any operators outside of China. They will still have to secure the heavy rare earths from China to make something happen there. But if you take the projections for the electric vehicle fleet rollout, there are going to have to be more suppliers of rare earths. And where the second thing that makes NMI interesting is we're starting to see a new attitude towards technologies such as electric vehicles, which are being branded as ESG friendly, meaning for environment, social, and governance. There are now systems being created to rate the ESG status of a product, and of course that's going to be a collection of different ratings from all the inputs. In this case, the inputs would be the rare earths used to make these permanent magnets that are critical to these electric vehicles. And last week we talked about the Smarter Markets podcast by Robert Friedland talking about the ABAX exchange, which is an information technology solution to how do you know that when somebody claims, oh, this is high ESG rated, that this is actually the case. So they're creating a market where from the mining source, you can have auditing going on that says this has been properly produced, it's in compliance with the country's environmental conditions. There are no local social license issues that are being violated by the way you are producing this. And in cases of countries such as Namibia, which along with Botswana are the least corrupt countries in all of Africa, you also get high scores for governance in the sense that, there weren't any backroom deals done with the local thugs who run the country to strip some of the revenues, to loot some of the revenues from the production of the country's assets that go into the pockets of these leaders of these countries and get squirreled out into Swiss bank accounts or London accounts or anywhere else. And so if this technology such as the ABAX exchange catches hold and becomes operational, it could become possible for production from deposits like the Area 4 zone at the Loftel project to be certified as having high ESG credentials. And then those who want to be able to boast high ESG credentials can bid within this ABAX exchange or something equivalent for the right to buy this. And this would end up being at a premium to what you get in China. The China price is what gave globalization a dirty word, because China had the cheap labor, the low health and safety standards, and of course almost non-existent environmental emission control standards. So that generated the race to the bottom, which destroyed manufacturing in other jurisdictions such as the United States, where labor laws, health and safety standards, environmental rules made it impossible to compete with the China price. But China has created a trap for itself because it is now a full-blown autocracy with a very high degree of surveillance and control of its people. You speak out or complain, criticize Xi Jinping for anything, boom, you get yanked away and accused of some sort of crime that's been fabricated. China has boxed itself into a corner where it can never offer anything other than the lowest quality, lowest ESG rated China price. And the rest of the world has sort of woken up and say, we do not want to downgrade our environmental rules and our worker standards to those of China, and we're tired of waiting for China to join Western democracies and upgrade their standards. They are on a mission to eclipse the United States as an economic power, so they're not going to pay attention to stuff like that which undermines their competitiveness. But in the Western world, where branding is important, there was a thinker called Naomi Klein who wrote a book in 1999 called No Logo, where she criticized these big branded companies such as Nike, not even owning any operations, just production operations, just outsourcing it to the lowest cost jurisdiction and incurring all kinds of harm or causing all kinds of harm to the downstream victims, which the purchasers of their Nike shoes and that had no idea of what sort of harm was caused in the production of these brands. Now we're seeing a turnaround where the brands are becoming very conscious. And the United Nations just put out a report where they observed that the 1% richest portion of the global population has the same CO2 or greenhouse gas output has twice the output of the lower 50% of the world's population. And that isn't supposed to be an argument for, we need to redistribute the wealth and all that. No, what they pointed out was this group, the 1%, can reduce if it reduces its footprint by a factor of 30, in other words, to about 3.3% of what it is now, they could actually make that difference to bring the climate change trend to a point where we're not hitting that tipping point where it is a hopeless runaway situation. And the challenge that has been put out there is that these 1%ers who have this surplus wealth have the ability through their decisions to allocate their capital to buy a Tesla rather than some other car which has a very high ESG rating. So the companies that have these brands, they've caught onto this. And in the beginning, it's just the elite that is buying these technologies. They're paying through the nose. It's actually an irrational act because they're paying far more than the equivalent, fossil fuel consuming technologies. But because they can afford to do this, it's a form of leveraged giving where the loss that they personally suffer ends up contributing to a greater good. Because just like in the beginning, it was only the elites who installed expensive solar technology on their roofs, knowing that this made no economic sense. But that demand ended up creating R&D innovation so that solar prices are now far cheaper than anybody imagined a decade ago. And a similar thing is now happening with all these so-called green technologies. It's that the purchasing of these high ESG branded products by the 1%ers is driving more and more R&D. Even the lithium-ion battery is undergoing dramatic changes. And the holy grail there is one where you can have lithium metal as the anode, and for that you need a solid electrolyte. And a company just went public called QuantumScape, which has a a ceramic electrolyte that's solid, and their battery has a lithium metal anode. Now, apparently, they're still like 5 years away from, commercialization, but there's all this money going in pursuit of making this technology ever better and cheaper. So when you are able to take your inputs, such as rare earths, nickel, cobalt, scandium, whatever, and assign an ESG rating to it and create a market which creates trust that this reading is real, and the manufacturers then can go out there and buy this, and the consumer trusts that when they say this is like highly ESG rated, this is not just greenwashing BS that we're doing because we think you're stupid, then you're going to see capital flow into these projects where the project is not very good at the China price for metals that come out of China. You'll get a premium pricing, and as the whole sector takes off, you'll probably end up seeing higher prices for rare earths because they'll end up coming up with thrifting ways of using less. So it's not like the demand's going to crank up the key inputs, making the product too expensive for the masses to adopt. So we're heading into this 20-year period where the 99%ers don't need to make the sacrifices of buying a very expensive electric vehicle. It's going to be the 1%ers who are doing this, and they're going to drive the R&D and the technology build-out that brings the price down and makes it affordable to the 99%ers. It's a beautiful way to deal with the China price created by the lowest standards on the block, which is what has given globalization a bad name. Globalization can get back a good name when globalized trade starts taking the form of these ESG certified metal outputs.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser, his website kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.